Okay, I started it again.
Good afternoon and welcome to the future management team of Ferris Industries. I'm here today with my associates.
I'm Jonathan Zhang.
I'm William Barking.
Henry Nola.
I'm Hannah Duma.
And I'm Daniel Gordon. First, we're going to discuss the highlights of our performance in the past 8 rounds. Secondly, we're going to discuss what our strategy was and what revisions we made to our strategy as the competition progressed. We're also going to talk about the major mistakes we made and what we learned from them. And finally, we'll discuss our major recommendations for the incoming management team.
Firstly, I will talk to you guys about some difficulties we faced early in our business. Our bump in the road occurred in years 2014 and 2015. There were a number of poor decisions that were made that caused credit ratings to go down. First of all, we far underproduced, and we did not meet our potential market share. Underproducing prevented us from achieving potential sales. This contributed to poor return ratios and a smaller profit. Despite these errors, no emergency loans were used because our sales were still able to cover the costs. We had enough resources to take a hit in the short term. Another thing is, the 2 product offerings we had were very similar. These similarities we had launched lessened our sales as well.
After our firm's meltdown in 2016, we as management decided that we need to reinvent our company and sort of just decide on which strategies would lead us forward in the coming years. In this way, we decided to use 3 strategies to create one super strategy to sort of guide our company forward. We used the broad differentiator, the differentiator with product lifecycle focus, and high-tech niche differentiator strategies to make one great strategy for our company. We developed multiple product lines. We worked on our R&D competency to keep our products relevant. We increased our production capacity to make sure stockouts were kept to a minimum. And we developed an aggressive marketing campaign that increased the awareness and the accessibility of our products. We automated our production and increased the efficiency of production to lower costs.
Okay. Over 8 years at managing Ferris, we produced 4 products, 2 being in the high-tech industry. One dropped in the middle and one was in the low-tech industry. The 2 products in the high-tech industry were Felix and Fanta. Felix generated a lot of sales, and with this we were able to increase market share in the high-tech industry. With Flow, the low-tech product, we were able to gain also more market share in the low-tech industry.
Our mission is to provide premium products for a fair price. We are dedicated to the ingenuity of our products so that they remain relevant. Our brands are accessible and withstand the test of time. Our vision from the very beginning was to provide customers in the sensor market with products that are high-tech and reliable. We hope to continue to be as dominant in the foreseeable future. In order to be successful with our vision for the company, we had to establish a strategy that focused on research and development. This would keep our products in alignment with consumer expectations and to make sure our products were always ahead of competitors' products. This would be successful because it would establish a loyal customer base. Our mission from the very beginning was to provide customers in the sensor market with products that are high-tech and reliable. However, there were a couple of strategy changes that were made because of the early lack of growth. As aforementioned, underproduction was the cause of lack of sales early on in our business. Our original strategy did not allow us to meet demand either. We also did not automate enough and acquired large labor costs. Therefore, our success in the end was dependent on the ability to adjust to the market, and we came up with a hybrid strategy.
There were various changes that we made to our strategy throughout the competition. Originally, our goal was to be specializing in the high-tech industry. We thought that having 2 high-tech products and 1 low-tech product would suffice, and that we did not need to introduce any more products, as product introductions were costly. We learned, though, that since the low-tech industry comprises the majority of the market share in the sensor industry as a whole, we did need to get more into the low-tech industry. This is when we decided to reveal our second low-tech product, Flow. This product was marketed as being cheaper than our other low-tech product, Fast, and it was a very big success. By the end of round 8, our low-tech products accounted for 45% of our profits, so it was of great importance that we shifted our strategy to also include low-tech. Additionally, we made changes in our R&D strategy. Originally, our strategy was to have one or two of our products drift slowly from high-tech to low-tech. This would reduce our R&D costs and possibly allow us to introduce one less product. We soon learned, however, that this was not a good strategy, as letting our products simply drift would leave them in a gray zone and would make us constantly have to change their prices. We decided to upgrade our products each round so that they stayed in the same point on the perceptive map. So we upgraded each of our products by the drift rate in their segment. Additionally, we made changes to the way we forecasted for our demand. For various rounds in the first few rounds, we way underproduced, which cut into our profits. We ended up coming with a more scientific way to measure our demand. So we took our previous year's potential demand, multiplied by the growth in the sector, whether it was high-tech or low-tech, and plus 50. This allowed us to produce more accurately, and it allowed us to have fewer stockouts, generating higher profits. Finally, we also changed the way we raised money for investments. Whereas in the first few rounds we had gotten most of our money from long-term and short-term debt, we realized that this was not a viable option as our interest expense was simply too high. In round 6 and 7, we introduced secondary public offerings of our shares. This allowed us to raise more money through equity and allowed us to raise less through current debt, which reduced our interest expense. While we were somewhat worried that this increase in our shares would result in dilution of the share price, we were confident that our increasing profits would mean that our stock price would surge and the dilution would not have a huge effect. And this is what ended up happening.
So, as incoming management, it is important for you to realize where your company stands within the market. Therefore, we're going to provide a quick SWOT analysis for you to realize this. First off, here are our strengths. Our company has very strong R&D competency. We develop our products according to the drift rate, and they remain relevant. Our market share is incredibly high. We have a dominant market share in the high-tech segment with over 32%, and have increased our market share in the low-tech segment to 16.4%. We have a very aggressive marketing strategy that maintains product awareness and product accessibility. We have sound finances, which means that we have a strong stock price, and we have the resources to manage our investments. As well, our production capacity keeps growing, and this enables us to meet product demand quarter by quarter. Moving on, fortunately every company has weaknesses, and these are areas in which you as new management will have to improve upon where we did not. Initially, we had a lack of presence in our low-tech segment, this just being our initial strategy and its flaws. As well, we were poor at forecasting, and we were unable to predict how much of a certain product we should produce or what our rival companies would be doing. Our operating costs are always very high. This is just because the actual cost of producing high-tech premium products is incredibly high due to the material costs. The labor is not that much more expensive than our rival firms. It is just that the material cost of producing our products is high. And this is just the natural cost of doing business in the high-tech segment. Moving on, we have our opportunities. So in our company, we believe that there are opportunities for you to expand into the low-tech segment of the market, just because this is the most profitable area in the sensor industry. As well, continued plant expansion will enable you to keep meeting product demand and enable growth in the company to produce more and to gain more profits. As well, we believe that you must keep increasing your dominance in the high-tech segment because that is what our company is known for and that is where our strengths lie. Our company is known for producing high-tech premium products, and this will allow the company to keep operating and producing profit. Finally, we have our threats. The increasing cost of operations is constantly a threat, meaning that if the cost of labor rises, the cost of production rises in terms of material costs and operating costs, then the company's bottom line will suffer. As well, rival firms are obviously another threat, specifically Andrews. It is difficult for a company like ours to compete with Andrews because they are in the low-tech segment and their operating costs are really lower than ours. And this makes it difficult for us to compete with Andrews on a profit-by-profit basis because their costs are so much lower than ours. As well, increased drift rates are a threat for a company because our flagship product, Fast, has always drifted in between the two segments of the market. And now that the two segments have finally drifted apart, you must choose whether or not Fast is a low-tech or high-tech product. Fast is able to turn a profit because it catered to the largest number of people and Fast in high-tech and low-tech. And unfortunately, this is no longer the case. So the drift rate is also another threat.
This past year, Ferris had extraordinary success, which can be highlighted by some specific numerical figures. Our cumulative profit was $77 million. In addition to this, we had 2.8 million shares outstanding, closing at a price of $87. As well, our sales reached $169 million, and our net income for this past year was $33 million. This left us in great financial position, as our cash on hand was valued at $35 million. Most of our success can be contributed to our domination of the high-tech market, as well as maintaining a competitive advantage and presence in the low-tech market. Most of our success can be attributed to our domination of the high-tech market, as well as maintaining a competitive presence in the low-tech market. Our high-tech market share was 33%, and our low-tech market share was consequently 16% as a result of not having as many products in that market. Our goal from the beginning was to specialize in high-tech products, and we firmly believe that our dominant market share in the high-tech industry proves that we have achieved this goal.
Overall, the takeaway lessons and advice to you as future managers are to forecast. Forecasting is key. For example, forecasting the amount of sales of the products next year. Secondly, appointing a general manager for each department, such as R&D, marketing, finance, production. However, you should all input decisions together collectively as a team for the next year. And thirdly, use other companies' decisions in the past as a source to help make decisions in the future for your own company. So for example, comparing Ferris's product pricing to competitors' product pricing, so therefore we can establish the best price for our products in the next year.
We have some recommendations for the incoming firm which will help them to be extremely successful in the long run. First of all, lowering operating costs. Our firm's net income was affected because these high operating costs increased our expenses, which ultimately took away from our total profits. Secondly, we advise the company to continue to maintain its dominant market share of the high-tech products. At Ferris, we are known for our high-tech products, and with this cash on hand, valued at over $35 million, more money can be allocated to increasing more high-tech products and making them even better. This will further the presence of that Ferris has in the high-tech market and will ultimately lead to greater success in the long term. Finally, there are still some companies within the industry that are threats to Ferris, and it is advised for them to enter more products in the low-tech market to try to take over some of their market share. In addition to investing more money in the high-tech industry, our cash on hand can also be allocated to integrating more competitive products in the low-tech industry. If all these goals are achieved, it is firmly believed that these will all help Ferris to continue to be successful in the coming years.
From our presentation, it should be evident that Ferris is the best and most dominant team in this industry. Firstly, we had the highest profit in the final round, and we are poised to continue being #1 in profits in future rounds. We also ended with the highest market capitalization, and we had a dominance in the high-tech industry, which we should continue to grow. Finally, we have our new low-tech product, Flow, which is going to be a huge success, and which will allow us to continue to succeed in the sensor industry.
So with that, we will conclude our presentation to you, the incoming management team. So for all of us here at Ferris Management, I'm Henry Nola,
Jonathan Zay, Will Walking,
Matt Zuma.
Daniel Gordon.
signing off. See you in Hawaii.